Hello, folks. Welcome to Market Trends. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. We do these webinars every Thursday. It's good to be back. Dog days of summer. Showing you some disclosures to begin. And this is what August feels like. It can be kind of like watching paint dry, just heavy, volatile sometimes, and then lethargic. And next week will be probably even more so because we're going to have even less events next week. Now, if you go to tradestation.com and you go to insights, it'll bring up our blog. On the blog, we have the article that highlights some of the main things we're going to be talking about today. The main thing that everyone's kind of waiting for is Jerome Powell at Jackson Hole tomorrow. And then it's a very quiet week next week. We have PCE, but really not much of anything next week. So, I mean, it's creates the opportunity for, I think, the market to kind of struggle and limp and drift. I'm also noticing, there was this sort of thing happening in the Red Sea with an oil tanker. So, I mean, geopolitical stuff is one of these crazy wild cards, but you just have to remember it's always kind of there, and that potential sort of thing that might pop up, especially at a time when there is less real news, so to speak. So the articles I wanted to look at was this one right here. I also had to look at this one very quickly here because there's some interesting things happening. So I'm going to start off just by actually let me show you some standardized returns to begin. We will be talking about some of these ETFs. So if you want to see their standardized returns, I'm also going to provide a link in the chat that you guys can see if you're interested in seeing more information about things like these ETFs, some of the disclosures that we have for this webinar. So, in the rundown that we did right here, volatility's historic rise and fall, we mentioned this high from August 1st. And that's essentially where we are. I'm going to jump over now to the MTES workspace. This is one that is included in the zip file that is included at the top of the blog post. So you go to MTES. This workspace has an hourly chart of the cash index of the S&P and an hourly chart of the S&P futures. Now, this is the high of that big reversal day back on August 1st. Man, was it 3 weeks ago now? That was at that time, we had kind of mentioned that things, that there were some bearish patterns, and it did work out. We had a bearish outside day right there, and then we had that big continuation, and then obviously this strong rebound. So now that level is an important level. I was surprised by how well we shot through it. And what's interesting now is that we're basically back trying to hold that level. So this is, I think, very interesting. Basically the close of the preceding session on July 31st, this is the close of July. So we're still positive on August. We went from being down a lot, probably 7-8% to being up almost 2%. So it's a very volatile bit of time here, but I think it's important to realize that this was the big reversal day that we've already now reclaimed. And now, holding it, I think, is going to be something that people might view as a positive sign. Now, the thing is, it's a very large, this was an entire day. And so if we look here over on a daily chart of, let's just go to the S&P over here. In fact, wait, I have this one. Let's look on here. So if we look here, this is the S&P here. Some other things, but basically we have this entire giant candle. This was one of the biggest candles in a long time. It was a bearish candle. And so the thing now is, I think that all the way through here, these are areas that, people might be looking for some potential, kind of support or significance. And I think what's interesting here is one of the things that we have talked about is the pattern of tightness. Extremely tight right there back in November, for example, when we rallied back. Extremely tight to the upside. So the thing now is we have this really strong move. And now the question is, in a time like August, early September, that is traditionally very volatile, the question is, does this actually start to look like this? Do we get a day like this? Or we start getting price action that tightens in above this bearishness here, above that bearish outside day? And I think that's really the question now. Today we have an outside day, but one candle in and of itself, I mean, this outside day occurred following 2 to 3 weeks of downside. It also occurred, at a time when it was under the 20-day, kind of knifed under the 50-day. Now it's nothing like that. So, one big outside day when you're trying to, hit new highs. We have a gap from way back here on the kind of the 17th of July. So, from my perspective here, the question is, does this turn into a period of relative tightness? And I think that's something that I'm kind of watching for, because when I take a step back and I look at this here, barring some kind of potential geopolitical risk, this environment in some ways is getting more favorable. I think when we look at it, the Fed, with the situation where they are. But one of the other big things I think is most interesting here is the total weakness in something like crude oil. Let's take a look here at wait a second. CL, crude oil, really, I mean, you could say this was because of when you consider the potential situation with an oil tanker getting attacked, what do we have? We have oil basically bouncing near the bottom of its range. Excuse me, bouncing near the bottom of its range. Not something really significant. This is something that also remains, from an inflationary perspective, a Fed perspective, very interesting, or at least I would say, not worrisome for the Fed. 10-year Treasury yields yesterday closed at actually the lowest level. The closing level of the 10-year Treasury yield index yesterday was the lowest level. If you look here, it went all the way back for more than a year. So when you look at something like this, I mean, this now just, I mean, it's you can see a potential channel there to the downside, and at this point, is this really anything here that gives a suggestion that yields are going to suddenly reverse to the upside? So I think right now we're in a situation where the market this morning got a little bit ahead of itself. This uncertainty tomorrow, and then the other big thing that we have, and I'm going to get to that, is the rotation that we really seem to have, and I think people might want to be thinking about, extending and respecting the potential rotation that we're now seeing, away from the large caps and toward things like value, towards things like small caps, because some of the numbers seem to be kind of supporting it. And I think it's important to realize. So, we have entered now the second half. The second half began with an explosive rally in small caps, began with weakness in mega caps. We had a massive oversold condition in the Nasdaq, in the mega caps early this half, early, or I would say, early August. Had a violent rebound from that, and now that is no longer true. Now we're basically just sitting. So I think right now we're in a situation where, if there is going to be a change of character of this market away from the mega cap growth toward things like value, financials, industrials, small caps, retail, that sort of thing, the groundwork is potentially in place for that to happen. And we have NVIDIA earnings next week. I should say next week we have NVIDIA earnings, and we also have like PC on Friday. But I think those NVIDIA earnings, I think that something people might want to entertain as a potential risk is the fact that people might sell the news. I mean, that's always something to think about. NVIDIA has had, these some of the earnings reports. Like if you look last year, when it rallied in May, and then it basically moved sideways until, the beginning of this year. And so now we've already had a big move. And so the question is, does it break out to new highs? Or is this something when it may have a period of consolidation? So I'm not trying to predict anything, of course. It's just a question of saying, where is the kind of probabilities and the risk at this moment in time. And then when you consider that scenario of improving breadth in the market and things like that, improving participation of other parts of the market, the over concentration in mega caps, this could be a sort of time when we want to at least be thinking about the potential for there being that small cap trade, that value trade, the financials, the industrials, that sort of thing. And then the other big narrative I think that's taking shape is what's happening with the US dollar. So I'm going to just quickly bring up on TradingView. It's a little bit easier in TradingView to show you this. Is it basically here, if you look at the dollar index, well, actually we did an idea today on TradingView, I should mention, if you want to take a look. If you're right here on the blog post and you click on here, you'll see this idea that we did about the Russell. So we had actually done an article on the Russell immediately before it had that big rally. This is a ratio of the Russell divided by the Nasdaq. Now, on TradingView, it's easier to do these ratios, and this was a huge, like, decline for years. You can see the Russell underperformed the Nasdaq. It's literally the price of one against the other. If you look at on like a monthly or quarterly, I mean, these are all kind of messed up here. I'm going to just hide those. But the thing is that you can see that the Russell hit like an all-time low against the Nasdaq. So it's one of these things where if it simply reverts for a few months or a quarter or two, that could be something that could potentially bring the Russell back to its 52-week highs, which are back from November of 2021. So the thing about the Russell here is the S&P went to new highs this year. The Nasdaq went to new highs, I think, last year. All these other indexes have gone to new highs except the Russell. So I think that just puts something here to think about. So anyway, this is a TradingView idea we did. And so this was the one that was on my screen. But the main thing I wanted to show you here was the dollar index. So, from my perspective, when you look at the dollar index, we do have some markups on this. Is that basically we had done an idea also on TradingView using this very chart about these converging lines that it broke to the downside. And, what's interesting to me about this is if you look at this, you could say, yeah, go back to the lows from last summer. That's something that potentially makes sense to me. But I mean, or at least, potentially could be something people could think about. But, if you look below that, I mean, this is something on a long-term chart, like 2 weekly chart, bars or something. You can see in the long term here, all this space that the dollar has, it has more potential space to the downside, the dollar index. You just look at the way the ranges it's been in at a time when the Fed is cutting interest rates. So just something to be thinking about here. From my perspective, if we enter a trade of dollar downside, what that potentially does to things like gold and silver, maybe crypto, what it does to some emerging market stocks, things like that could have a very different kind of market than we've seen. If you look how the dollar started rallying back here in 14 and really was in an uptrend all the way through September of 2022. And so the question is, all of the boom in mega caps happened in a context of a dollar that was at least neutral or bullish. If we're entering a different kind of environment of a dollar that's trending to the downside, it's not to say it's overtly bearish for tech stocks, but it is something that could result in a very different environment. And I think that's something people want to be thinking about. Things like gold, silver, metals, emerging markets, other sorts of stocks and things like that. That could be something to at least have on the radar as a possibility, and be looking for some of those things that might happen. So to me, this is actually now, before we were saying that the 10-year Treasury yield was the most important chart, and this is a 2-week chart that you can see how it clearly has shown some important patterns. We really emphasize this lower high it made back here in April, the way that the downtrend was steepening. Now you can say, I think it's the pressure still looks to a certain extent that there's more kind of people not really pushing this to the upside. But from my perspective here, the chart now that could matter more. And what we had said was that this moving lower would be something potentially bullish for stocks, which it was. But now I think in some ways we want to look beyond the 10-year and we want to start looking at the dollar index. This could now be the other chart that really informs where the S&P is going and where overall risk appetite is. On one other note, I'm going to just mention to you, everyone talks about the dollar yen, and it was this big thing that freaked people out. I would just mention that if you really do want to look at currencies, to me, the dollar yen is potentially less meaningful than something like the euro yen. The euro yen has a little bit more of an all-on risk appetite. The problem with dollar yen is the dollar can be a safe haven and the yen can be a safe haven. So comparing one to the other doesn't always give you a true picture. The other problem is the dollar index includes the yen. So if the dollar, if the dollar is weakening, it will also weaken against the yen, which means dollar yen, which will go down, which will give you a false impression of risk. But euro yen is a kind of pure risk, currency pair. So I want to just mention that if people are looking at things, you hear all this buzz about the yen and all that stuff. My, kind of thought is that was something of a crazy flash in the pan. The yen just kind of came out of left field. This might be more of a real black swan event that we actually saw. People use that term a lot, but it basically means a statistical anomaly, things that don't happen a lot. And my sense is maybe that's actually what the yen's meltdown or the yen's rally was recently. So let's take a look now at um, our key ETFs, because what we actually see when we look at the performance here, let's look here at the spider funds. Today, what's doing well? Energy, financials, real estate, industrials are barely down, healthcare is barely down, materials. All these are in many ways value stocks. And the real growth sectors, XLK, technology, XLY, which includes Tesla, it includes Amazon. These are the growth areas. These are our three growth funds: XLC, XLK, and XLY. That's where our weakness is today. Interesting to see regional banks actually doing very well today. So I think right now, if we look, you can see that the Russell is outperforming the S&P and outperforming the Nasdaq by a pretty wide margin. So these are also, I think, just interesting things to kind of say is potentially kind of giving us some evidence of some of the stuff that might be happening. Now, I'm not just always trying to harp about the Russell, but I think the thing is that we are at a point now where the Russell, it has that relative ratio to the rest of the market that is really historically out of whack. And the other thing is that it's at a time where people have this expectation of what's happening with the Fed. And there's also a lot of things happening here. We look at things like breadth. So now we go to our MT breadth, another workspace. We can see here that the S&P 500 made on the S&P, the advanced decline line made an all-time high yesterday. Today we have more. You see more companies making 52-week highs. We can see more companies have their 20-day above the 50-day moving average. All these are things that give some signs of overall strength. If we look at the Nasdaq, it's kind of interesting. Look at the Nasdaq's advanced decline line, the Qs. I think it did not make a new high. If you look at this, it's just kind of topping more. But the thing is that the Nasdaq doesn't really actually give as much as I might have thought. But I think the key thing is this is a Russell, and I always just look at the S&P. I wanted to just quickly see if the others gave us any information. But to me, the interesting thing here is that the advanced decline line made a new all-time high before the index did. That's a sign of positive breadth. And then you also see more stocks making highs. So that's very interesting. Now, if you look at this article we did on Monday, there was some really dramatic factoids in here. One of them was the fact that basically you had the market was down 7.3% at one point on the month, and then now it's positive on the month. And so what's interesting is the number. I don't have it. I can't find it right here. 85% of the S&P went up last week. The biggest decliner last week was down 5.5%. 63 stocks in the S&P 500 rose more last week than the biggest decliner. So it's really a kind of dramatic thing overall. And we are continuing to kind of see that. And I think when we look right here at the MTES, again, we are holding. Look at this. It's stepping in as support here. So I would just say that an outside day, a bearish outside day on the S&P 500 in and of itself is something that it's a kind of one candle. People would want to often look for confirmation if they want to view it as a bearish thing. But like I said, to me, the really important thing is to look at the trend leading into it. The trend leading into this bearish outside day was more to the downside. MACD was falling, and then we had an outside day that just triggered the sell-off. Now MACD is rising. Volatility has also been fading. This is historical volatility. So this huge run up in volatility, and now it's been fading. Even with the market having, down a healthy amount today, we still see, this is the 10-day historical volatility. So I think these are all just kind of telling us patterns that at this point in time, the nature of this rebound, the way that we got above our reversal day is something that is kind of breathtaking when you really think about it. So I think now we're watching to see, does this old resistance become support? And judging by the price action that we're seeing so far today, it is doing that. So that's pretty interesting. This is what we had mapped out. These are a bunch of different charts I used when I prepared this webinar. Let's now go through some of the other points I want to cover here. I note these things here. Like if you notice, just the fact that these are just some kind of inside baseball points. But at different times, I showed you another indicator that shows the distance above something like the 10-day moving average. And the actual, like this, the absolute surge when the market was crashing back on August 1st. We were showing you guys how the S&P was down a really dramatic amount versus its 10-day, and then it went flying back way above its 10-day. We actually have it as one of these in this one right here. I'm sorry, it's in. I have too many charts, and so basically, this shows the S&P 500 against the 10-day moving average, just as a percentage. This level here was a huge drop. I mean, this was like the most negative since like late 2022, or middle. And so, I mean, it was something in the context of a market that had been trending higher was pretty dramatic, because when it went that low back in 2022, the market had been falling for like 6 months. This time, it was falling for a few weeks. But then we got to a point when it was way overbought here. But then look back here in November when it also got to that distance. What did it do? It moved sideways, had a few negative days, and then continued. So what do we have here now? We're moving sideways. The 10-day moving average is rising very quickly. The 10-day moving average here was falling. So this is what I mean. The bearish outside candle occurred in the context of a short-term downtrend. Now we have a bearish outside candle occurring in the context of a short-term uptrend. So two different sorts of things here. So that's what I said. Let's see now if this upward sort of thrust will provide some kind of support to kind of help us form a period of tight consolidation that then gives way to potentially more upside. I think that's just this is the big question before us right now. So when you look at the data overall, some of the news that was out there, it was interesting to see basically the way that the government, revised down these employment numbers were kind of interesting. These numbers showed people were pessimistic about the labor market. But again, all these things are kind of, favorable for the Fed wanting to cut rates now. They are not favorable if you're looking for higher inflation, So, I mean, these things are actually now, overall positives. Oil getting dragged down, people worried about the economy, lower employment growth. These things right now are, positive, or I don't want to say positive because that implies higher inflation, but basically the key thing is these things are consistent now, potentially with a dovish sort of outlook. I was surprised by how dovish the minutes were. They said the vast majority. I mean, these guys know when they use language like that, that gets people's attention. Using a term like vast majority, I mean, this is something that's a pretty strong sort of statement for the Fed to make. They also had a majority remark that the risk to unemployment had increased to the employment goal. So this basically saying the Fed is more worried now about job weakness. So we have job weakness, we have job weakness, we have job weakness. Okay, we have the Fed with a vast majority wanting to cut rates potentially on September 18th. So these are the sort of things that are kind of in the background now that were not necessarily in the background 6 months ago. I also saw something that I got to watch this more. But the American Association of Railroads puts out every week rail traffic. The increase this week was jaw-dropping, 8% upside. So numbers like that do not happen outside of like back in 2021 when we were comparing to COVID. If you go back to like June of 2021, it was up like 20% or something because during COVID it had dropped so much, so you had a base effect. But this time, this rail traffic increase, I think, is very interesting. And it also is kind of more consistent with an economy that is not terrible. So we have a situation where employment is kind of soft, but at the same time, the economy is, not confirming, a real problem. So now the CME is also showing that the FedWatch tool is showing a higher increase of 50%, of 50 basis points. Still, probably that's not where the market is pricing. But the thing is we're now more in that direction where the dovish story is increasingly kind of accepted and kind of baked in. This is interesting. A guy named Jim Paulson, I used to watch him a lot. He used to be at Wells Capital. He used to be a pretty significant asset manager. He now is on Substack, I think, but basically he had noticed that the positive GDP and a falling inflation, he says it favors value in small caps. This scenario of, is a note he put out recently, if you want to check that out. Also interesting, we saw some real drops in sentiment recently. Let me actually just help you take myself off the screen here. But basically, if you look here there was a report from S&P Global said risk appetite was the lowest, 1-year low this month. And then also, We saw more information like that today. We actually saw something of hedge funds being, according to Goldman Sachs, being like the most negative in a long time, which again, very interesting. They were had the smallest exposure. What was it? It was that I'm looking at the screen here. Hedge funds are avoiding stocks, and they were the biggest sellers since March of 2022. So, also pretty interesting. Um, just to see that the sentiment is not overly confident, it's not overly complacent. And these are the sort of things that are also not, consistent necessarily with the market kind of being at a top. So I want to just kind of point this out is that, we did see the American Association of Individual Investors get way more bullish. Their survey get way more bullish. But I think overall, when we just look at it, when you have a rebound in the market that's that violent, you're going to get some degree of momentum. I think the key thing here is just that we don't, is that there is enough negativity that's out there. People are negative to a certain extent. The job situation is not good enough for the Fed to keep rates high. So all these things here, when we look at them, they're in a spot where, there is, there's just not the sort of stuff necessarily that creates a sort of overall bad environment. People look out into the future. What do they see? They see Nvidia earnings. They see Apple with the iPhone coming out with AI on it, which is broadly expected in September. Then after that, they're going to see the Fed potentially or expected to cut rates. Then after that, we have earnings season. And you look at some of these earnings reports, things like TJX and Target. And these earnings reports are, we're much better this earnings season than people expected. Remember, we are now entering a period of double-digit earnings growth. This year and next are going to be double-digit earnings growth. So people talk about high multiples. Remember that very often multiples are highest when the market's rallying. And then what happens is that before they crash, multiples are cheapest because the market rallies before the growth. It stalls when the growth happens, and then it pulls back as the growth stops or reverses. But we're in that stage now where the growth is actually now entering an acceleration phase in terms of earnings. So all these things I think we have to kind of just bear in mind. The last thing I wanted to show you is I created this quick little chart. Um, well, first, I'll just show you this really quickly. I think it's kind of interesting using some of the tools we have to just look at where the different indexes and things are, and where do things compare. And I'm just interested to find this. So, for example, against the 50-day moving average, the Nasdaq is actually below its 50-day moving average. It's kind of interesting. XLK is the only one of these is below the 50-day, and so is energy. Now, you guys know that I've been saying for a long time that the energy scenario, is difficult for various reasons, especially because China's weak and OPEC plus is just basically opening the floodgates of oil production. So that's been my overall outlook for oil. And so energy to me is just, even if the value thesis, whatever, to me, it's just kind of out the window. We are in a stage of secularly cheap oil because of improved technology, a peak in population growth, and a gradual secular shift toward less energy consumption per unit of GDP, no matter how you slice it, whether it's electric cars, hybrid cars, people working from home, more efficiencies, etc. The overall use of energy of petroleum, has, from a secular perspective, um, I'm not going to say it's peaked on absolute terms, and in relative terms, it has. And I think when you consider on that top of it that the Chinese situation, which we have talked about a lot, is a very difficult environment that China is in from a GDP perspective. So I think that those are issues that remain for energy. But if we step away from that and we look, what do we see? We really see that in the performance against things like the 50-day moving average. You can see here that that NQ, or the Nasdaq, is actually doing the worst. If you look, and then something like the Russell is doing the best. If we sort it like this, you can actually see that the Dow and the Russell, the more value sort of things, are doing better against their 50-day moving average. It's kind of interesting. So I want to just kind of very quickly point that out. You can use these different tools to compare, and you can see here, for example, that the XLK has a 10-day moving average below the 50-day moving average. This is a quick little one I do that kind of shows relative strength. And you can see here. And then, so the other thing I wanted to mention was I created a quick little one-off script. You can just go in here into studies, add study, and then it's called custom one line. We just go to custom one line like this, and you can then just go and you can add a single line of easy language right here in inputs, right? And if you actually look here, we actually give you guys a quick little thing. And this basically, now you can call it curve fitting. This is more for me for illustration. But the thing is on a 10-day change from this high to this low was the biggest drop in the history of the VIX, from a high to a low. So, I mean, I just kind of did it to illustrate. And that is what this is plotting here. So I want to just kind of show you, you can do a quick little analysis with, with the platform by putting in single lines of easy language into that custom one liner. And then you can treat it like any other indicator. You can change it from a histogram and things like that by going and doing the style tab. The style, I change it to a histogram. You can see I change its thickness. I can change its color. I want to make it white or something. You can see, boom. So anyway, that very quickly. The last thing I did want to just mention, going back to my MT main, was that I was looking here, and for people, kind of thinking about options trades, big names, things like that. One thing that grabbed my mind here was something like Tesla. I don't have my Option Station Pro in front of me right now, and I'm running out of time. But a name like Tesla here, people thinking about potential resistance and things, you know, something like Tesla, something like the 225 calls up to the 230 calls. So people might be thinking about, all right, has Tesla peaked at least for the next week or two? When you look at the options chains, there were people who might want to be thinking about things like selling upside call spreads to generate, potential revenue or income, to generate credit. And Tesla, with this rally up, with the expiration of next week, things like that might be, I don't have time to bring it up, but some of these things right now might actually be something that people might kind of look to and be thinking about. We have a situation here with Tesla where there's all kinds of issues with the company fundamentally, and then on top of that, you have simply the macro environment of where it is. And so lower high here on the technical backdrop. The other thing to me was Amazon, also kind of at a spot here where high valuation, potential resistance right here at the lows of July. And then the other one, also someone here, might be thinking about upside call spread of something like selling credit. Remember, this is a trade looking for the stock not to go up, selling something like the 180, 185 call spread for next week. That one kind of popped up on my radar if you want to take a look on your own Option Station Pro, on your options chain. And then the other one is Nike. Nike also has had a pretty healthy bounce in the context of a downtrend. And this is also one people might want to be kind of thinking about. Does it kind of want to stall and peter out and roll over? So these are some of the things that were kind of jumping out to me when I was looking at overall trends here. But like I said, I think right now the main thing I'm kind of watching is, do we see that rotation toward value, toward financials, toward industrials? The last thing, when we do our market, state of the market on Monday, we've been talking about basically the XLI and this tight range that it's been in between 120 and 126 on the industrials, and how it might be potentially sneaking out of that range. Industrials, financials, materials, healthcare, also an industry that we've talked about that is just quietly under the radar, breaking out to all-time highs. Like we've said, healthcare is a secular growth area. And the last thing I'll just add is, you look at that data that we had on Monday with this big drop in employment, that they had here. What was it on Monday anyway? This drop here of the payrolls, it was all because of professional services being down. Healthcare is increasingly a driver of this economy. When you look at stocks like UHS, and a hospital company, HCA, these companies are taking off. So I think it's interesting here when you look at them, to see this kind of relative strength at a time when the market was crashing, and stocks like this basically were holding, these breakouts. I think healthcare is also another area here where people are starting to pay attention to it. So great to talk to everyone. I'll see you guys on Monday. If you want to watch State of the Market, we actually have the link here at the top. Hope everyone has a great day, a great weekend. See you next week.